Mortgage rates will rise like a rocket but fall like a feather. In this video, we'll discuss the 6 things that drive the mortgage market, the most important things that impact your mortgage rate, and I'll give you my opinion on paying points to buy down your interest rate. So in most cases, you're not able to lock in your interest rate on a purchase until you have gone under contract, identified the property you are purchasing. So until then, your rate is floating, subject to change for the better or worse. If you're new here, my name is Tim Kelly. I'm a loan officer right outside of Washington, D.C., and the purpose of this channel is to help you manage your mortgage and finance your real estate goals. Now, interest rates are a key factor when determining how much your mortgage is going to cost you over time. Simply put, the interest rate is the percentage the lender charges you for borrowing money. As we mentioned in the Mortgage Basics 101 video, a lower interest rate means smaller monthly payments, while a higher interest rate increases your costs. That's why it's so important to lock in your interest rate once you find a good one. With all that being said, there are 6 factors that drive the mortgage market. First, being economic data. Rates go up on good economic news. For example, when non-farm payroll comes in higher than expected, the unemployment rate goes down, and there's better than expected economic data in general. Rates will go down when job data is stagnant or declining, manufacturing is stagnant or slowing, and housing is weaker than expected. The employment report is released the first Friday of every month by the Bureau of Labor Statistics, and it's considered the most important of all economic indicators since it provides a first look at the current economic situation. Mortgage rates will reflect the strength or the weakness of these factors. Number 2, inflationary pressure. Rates will go up when the consumer price index is higher, with higher wholesale prices, and when hourly earnings are higher. Rates will go down when consumer prices are lower, wholesale prices are lower, or hourly wages are declining. Low interest rates depend on low inflation, which causes both wages and prices to rise across the board, and the cost of borrowing money to get more expensive. Remember, good news for the economy is often bad news for interest rates. Number 3, the stock market. Rates will go up when the stock market is on the rise. Rates will go down when the stock market is declining. The stock market and mortgage rates have an inverse relationship most of the time. When investors are putting money into the stock market and it's doing well, money moves out of bonds, causing prices to drop and interest rates to move higher. Number 4, the Federal Reserve. Rates will go up when they're pulling money out of the monetary system, because this usually indicates inflation is either here or it's anticipated by the Fed. Rates will go down when they're adding cash to the monetary system. This creates a looser credit environment in an attempt to stimulate the economy through borrowing expansion. Number 5, geopolitics. Rates will go up when China's GDP improves or tensions ease. Rates will go down when the European economy sinks or there are conflicts or acts of terror. Investors often turn to the US as a safe haven for investing whenever things go wrong in the world. And finally, number 6, other global events. Rates will go up when there's a serene landscape around the globe with little catastrophic events or weather. Rates will typically go down when there's hurricanes, typhoons, tsunamis, and earthquakes. So there are many things that can impact the mortgage market, but what impacts your interest rate? Well, as I mentioned in how much house you can afford video, your credit score plays a huge role in the interest rate you qualify for. I think it's the most important piece when determining your interest rate because ultimately it determines which mortgage product is more affordable for you. A higher credit score shows lenders that you're financially responsible, which makes you less risky to lend to. And as a result, you get a lower interest rate. On the flip side, if your credit score is lower, lenders may charge a higher interest rate to offset the risk. With a low credit score, conventional loan products through Fannie Mae and Freddie Mac may be more costly than products you would get through Ginnie Mae like FHA financing. Improving your credit score before applying for the mortgage is one of the best ways you can ensure you're getting the best rate possible. Another key factor when determining your interest rate for conventional loans is your down payment. In general, the more you put down or the lower your loan to value ratio is, the better your rate will be. However, there is some value or improvement when your loan to value ratio is over 80% and mortgage insurance is required. Another factor is the type of property you are financing. There are adjustments that increase the price or rate for condos and multi-unit properties. Single-family homes and PUDs like townhomes can have the best pricing. With conventional financing, you can see all of the adjustments made to your interest rate using Fannie Mae's LLPA or loan level pricing adjustment matrix. I'll link to it in the description of this video. Now, good news for some first-time home buyers, there are products that eliminate all of the adjustments that would increase your cost or your rate. I'll do a future video about those products that eliminate the adjustments for first-time home buyers and are often used to get first-time home buyers a great deal with conventional financing. Now, when choosing a mortgage, you'll often come across both long-term and short-term loan options, such as a 30-year fixed mortgage, which is often the most common loan because it offers a stable interest rate over a long period of time. But there are also shorter-term loans like a 15-year fixed mortgage, and that typically offers a lower interest rate than your 30-year fixed mortgage, but has a higher monthly payment. In the How Much House You Can Afford video, we talked about fitting your mortgage payment into your budget. Short-term loans can save you on interest, but they only make sense if you're comfortable with the higher monthly payment. Now, no matter what product you use, how much you put down, or what your credit score is, you can always use points to buy your interest rate down lower. Points are a percentage based on your loan size. So 1 point is equal to 1% of your loan. So on a $400,000 mortgage, 1 point is equal to $4,000. And buying points can reduce your interest rate. This means that you pay more upfront at closing, but benefit from lower monthly payments for the life of the loan. Think of it as prepaying part of your interest. Whether or not buying points makes sense depends on how long you plan on having your mortgage or staying in your home. If you think you'll be staying in this home for the long run, and have this mortgage for the long haul, buying points can save you a lot of money over that time. So deciding on whether or not buying points makes sense depends on a few key factors. If you plan on moving or refinancing within a few years, paying extra for points upfront may not be worth it. In the first-time homebuyer mistakes to avoid video, we talked about sticking to your budget. Consider how buying points fits into your overall financial plan. You also want to look at the mortgage market forecasts. What are economists forecasting mortgage rates to do in the future? If they are forecasting mortgage rates to fall, you may want to avoid paying points because you could end up refinancing before realizing the full benefit of buying your rate down. The rule I go by is if you are buying points, you want to break even in 5 years or less. Meaning I need to save back the additional costs I spent at closing from paying points after making 60 or less payments. So before you decide to use points to buy down your interest rate, you need to know what the rate is with 0 points. Then you can calculate your break-even point. But one important thing to note, if they are forecasting interest rates to be lower in the future, is that refinancing isn't a guarantee. You'll need to qualify for refinancing similar to how you qualified for the purchase. And there are many reasons why someone might not be able to refinance. In the future, your credit score could have dropped, you could have been late on your mortgage payments, you could have just had a change in your job, or there could have been a loss in your qualifying income, or perhaps your home lost value and now your loan-to-value ratios are too high. In my experience as a homeowner and loan officer, most of the time it hasn't made sense to buy your interest rate down with points. And that's because the mortgage market has been so volatile, lots of ups and downs. But I'm not the one making the mortgage payments, nor is your loan officer. So make sure you make the best decision for yourself. And if you found this video helpful, check out some of my other videos. Check them out. You might find them helpful.